James Cordier, founder of Alternative Options, commodity trading advisor. What is your view on the Federal Reserve interest rate path as we head into Q4 and what that means for the broader economy?
Chris, thanks for having me on again today. Just a week or so ago, there was a very clear path to interest rate cuts. There was one in September. There's likely two thought to be in fourth quarter of this year, and then perhaps one or two more early in 2026. But what just came out just recently was the fact that some of the governors mentioned that had the vote been not to cut in September, they could have gone along with that. And it seems like everyone was looking at nothing but cuts. We're definitely going to cut. We're going to cut some more. And some of the governors this past week said, as a matter of fact, that they would have supported the idea of no cut whatsoever. And something that we haven't really heard a lot was that those governors mentioned they see the biggest risk not being employment and the weak data points that we've received recently with jobs, but they're still nervous about inflation. And that's why they were considering the idea of not cutting rates. And what's interesting is, of course, that has propelled the US dollar to a level that's almost as high as it was back in May as the US dollar index approaches 100. So that is far different than where we were just a week ago when a lot of people were talking about nothing but interest rate cuts. And lo and behold, there were three or four governors that were saying maybe not so fast.
With that in mind, what is your view on the landscape for the stocks?
We follow the stock market almost as closely as anyone else. Of course, we're in the commodity space. But the United States stock market, along with China and most of the European indices, have made all-time record highs, something like 30 times this year. And we approached one again yesterday and the day before. Uh, it seems as though stocks are pretty much priced for perfection. And maybe that's what we have right now. Maybe we have the AI boom that's going to continue lifting other stock indexes. And but what's interesting is some really well-known people that really manage a great deal of money. The Jamie Dimons of the world, the Ken Griffins of the world. Uh, I've heard them quoted recently saying things like sugar high, that the economy and the stock market is on right now. And a lot of people are looking for, ideas as to whether they should stay in the market a little bit longer, should they wring out a little bit more profit yet this year, or should they perhaps take a little bit off the table? So interestingly, Chris, a lot of people sell at some of the most inopportune times. April, we had the tariff tantrum. A lot of very well-known stocks were down some 30 and 40%. And a lot of people that I heard discussing that would say, well, if you didn't sell, you wouldn't have lost that 30 or 40%. But, they don't just price stocks down 40%. That's not how it works. People are selling, and that's what brings stocks down 40%. So, easier said than done not to sell when everyone's panicking. Now we have just the reverse. We have people rubbing their hands together, stock markets at all-time highs. Some of the darlings that were really getting beat up in April are now sitting with a 2x gain. Nvidia is over double what it was back in April. So while you don't want to sell the low, if some people were wanting to take some of the chips off the table, they certainly wouldn't be doing that. They'd be selling the high right now. And when you get names like Ken Griffin and Jamie Dimon thinking that might be a good idea, it's hard to go against something like that.
Yes, FOMO versus fundamentals and technicals is definitely happening right now. So let's turn to commodities then. Given everything we've just talked about, what's your view of the commodities landscape?
Interestingly, we follow crude oil quite closely, the lumber market. These are two barometers for how the economy is doing. It really kind of cuts through the noise. When energy prices are high, that's generally from, strong demand for trucking and business and people taking vacations and driving and traveling. When oil prices are down, it basically is telling you the opposite. Oil prices this year have been extremely stagnant, just sitting in about a $5 or $7 trading range. Right now, Chris, as we go into what we call the shoulder season, which is after driving season and before heating season when it's frigidly cold in the Northeast. That is the least demand in the United States. So oil prices have been trending a little bit lower. Is that because the economy is not quite as strong as we thought? Perhaps it is. Globally and here in the United States, lumber prices just got creamed here in the summer, of course, with a weak housing starts. So the economy isn't as strong, perhaps, is what the stock market is. I know a lot of it is AI driven. Some people are calling it a sugar high or a bubble. That remains to be seen. You don't know until it actually happens. But in the commodity space, of course, silver touched $50 an ounce, the same price that it reached during the bunker hunt squeezes in the early 1980s. The gold price hit an astounding $4,000 an ounce. So a lot of people are looking at a weaker dollar, a less strong economy than people were thinking. And the reason why we think that is because generally speaking, lower interest rates are going to weaken the US dollar. And that is a good time to hedge a falling greenback. And you use that by buying gold and silver, perhaps. So the gold market is saying that lower interest rates are ahead. The economy is not as strong as we thought. And there are really a lot of great opportunities right now in the precious metals. We sell option structures in commodities, and with all the unknown variants going on right now, and with the volatility in those two markets, I think that's setting up quite well for the fourth quarter.
A lot to consider, a lot of great insights. James, thank you again for your time.
My pleasure, Chris. As always, thanks.